Trading the financial market is a highly lucrative career, but so are the risks involved. Too many traders want to make the big bag, buy the Lambo, and be financially free. Is this possible? Yes, but only after proper education. Welcome to class. Alright, welcome to the market structure guide. This is going to be the part 1 of this guide. I will advise that you watch this video to the end if you want to understand what market structure is about, and then if you also want to have a better understanding as we go to the second part. Welcome to class once again. So today we'll be looking at the Japanese candlesticks, and the Japanese candlesticks is a way to represent the movement of price on a chart. It was developed by the Japanese, and this is how it looks like. Okay, so now the candles are of 2 colors. People use different colors to depict them, but for this class I will be using green and this other color here, orange, to depict the 2 different kinds of candlesticks that we have. All right, so now it is important to understand what the candles mean in order to understand market structure. It is foundational to reading the price chart. You understand? The green color candle, which sometimes can be represented as a hollow candle in some chart, that is in the black and white chart, it represents a bullish candle. So the word bullish is to mean market is going upward, just as you can see represented in the body of this candle. So you can see the arrow pointing up. So a candle like this, whether it is green color or whether it is hollow or whether it is blue color, depending on whatever color you're using, because the color does not matter, it just depends on how you want to interpret it. Some of the colors can be psychological, it just depends on how you view colors, but in this case it's a green color and it indicates a market that is moving upwards. It indicates that the price of the asset is moving from a lower price to a higher price. So, and you can see, okay, another very important factor for you to know is that the Japanese candlestick charts depends on time. So each of these candles will be calibrated into different kinds of time frames, either the 1 minute or the 5 minutes, 15 minutes, 1 hour, depending on the time frame you are looking at. But it takes a particular period of time for a candle to be formed depending on the time frame you are looking at. So now the time frame I'll be picking for this example is the 1 hour time frame. So if this candle is a 1 hour time frame candlesticks, it means at the beginning of the hour the market will open at this price level that you see here. All right, so when it opens here, it will begin to make some movements up and down, up and down. At any time that the market goes below the open price, it creates what we know as a low price. So once the market goes below the open price, what you get is a low price. Do you understand? So now, also, as the market keeps doing this, a time will come also where the price will keep going above the open price. Once the market starts going above the open price, then you start seeing the green color if you set your own to be green. Okay, so then it keeps going up until it creates a high. All right, so the high is it can be any price level that the asset decides to move inside that 1 hour. And then when the market moves to that high, and let's say after moving that amount, it comes back to close at this price level. So once the price level is below the high, this is what you will see. But if it's above it, if it's above here, that means that there is no wick at the top, then the candlestick will be full. All right, so but what I'm trying to explain here is that this is the body of the candle, this is the open price, at the bottom here is a low price, this is the close price, this is the high price. Now for the case of the bearish candle, which is a price that is going down, the price of the asset that is going down, what you discover is the opposite. The open price will be a high price. It will be open, it will be at the top rather. So the open price is higher than the close price. Do you understand? That's the difference between the two. For the bullish candle, the open price is lower than the close price. While for the bearish candle, the open price is higher than the close price. But the high and the low, they remain the same in the chart. Do you understand what I mean? So if this were to be a 1 hour candlestick, it means at the beginning of the hour, the price opened here at the top, and within that hour, it moved up to create a high, and then started coming down, created a low, and then closed at this level here. So that is how the candlesticks move. So I'm going to show them to you in details as we progress. Alright, how the candles move. For a bullish move, the price will move from a bottom to the top like this. So this is one of the candles, and then because here is the close price, which I've already shown to you, here is the close price, the market is going to begin, another candle is going to begin from there at the close of that hour. So if a new hour is to begin, the market is going to begin from there in this manner. Do you understand? So, and then it continues this way, and then it continues that way. So the close price in the case of a bullish move becomes the open price for the next candle. Do you understand me? So that is what happens. Now there's something I want to show to you. For the bearish move, the same is the procedure. Okay, the process is the same. It will do the same thing. Market will close, and the next candle is going to open at the close of the previous. You understand? Just like this. Alright, so this is how it moves. I'll then point out something for you. You can see that this is the high of this candle. Look at this other side of the bullish move. This is the high of this other candle, and then this is the low of this other candle. Now between the low of this candle and the high of this first candle, there is a gap. Alright, so this gap is also known as the fair value gap. Do you understand me? This gap is known as the fair value gap. You see the market, this the low here and the high here, there's a gap. They are not touching each other. So the ideal will is for them to touch each other. So I'm still going to show that to you on the bearish move. You can see the same thing is applicable here. So there's always a fair value gap when the market moves like this. So if the low of this one is not touching the high of this one, that's a fair value gap. Do you understand me? So now the implication of this is huge, and I'm going to show that to you as we keep on going. Alright, how the candles should move. The way it should move is that once the market moves from this low and to this side and it closes here, the next candle, okay, comes up like this. Then you'll see this candle is supposed to touch. All right, let me show that to you. It's supposed to touch. Once it touches it the way you have seen it now, it means it is balanced. You understand me? This is how a market should move. This is the ideal way it should move. So the low of this third candle should touching the high of this first candle. That's how the market should move. But in the previous one I showed to you, you discover that the market did not move that way. So there is a fair value gap. You understand? So you can see the low of this candle is touching the high of this candle, so the market is balanced this way. So the same thing happens for the bearish move. We discover that the market has to be balanced. The low of this one, we have to touch the high of this third candle. So this is how the market should move. It should touch each other as it is going up or going down. It should be touching each other. You understand me? So that is how it should move. The low of this one should touch the high of this one. The same thing for the bullish one. The high of this one should touch the low of this one. That's how the market is supposed to move. That is how it should move. That's how the candles are supposed to be delivered effectively. You understand me? So now let's go to the types of market structure. We have the uptrend, we have the downtrend, and we have the sideways trend. Now for the case of the uptrend, the market moves from a low price in this level here now, okay, and then it moves up to a high price. All right, then it comes back to a low price that is higher than a previous low, so it is called a higher low. Then the market moves up again to a price that is higher than this previous high, so it's called a higher high. You understand? And it comes down to a higher low, goes up to a higher high, and then it comes down again to a higher low, and it continues down to a higher high. So this is a structure of an uptrending market. But these are the three types of structure: the uptrend, the downtrend, and the sideways trend. So this structure, you should not forget it. It will become your second nature as you begin to trade, okay? But for now, you should know that in the case of an uptrend, the market will create higher highs and higher lows. Do you understand me? So then for the downtrend, the market moves from a high price in this manner, and then it comes down to a low price, drops to a low price, and then it goes back to a high price that is lower than a previous high, so it's known as a lower high. Do you understand me? So then it comes down again to a lower low, goes up to a lower high, a lower low, a lower high, and then a lower low. So you should know that for the downtrend, it creates a lower low and a lower high. That's what it does, okay? The opposite is the uptrend. For the uptrend, it creates higher highs and higher lows, while for the downtrend, it creates lower highs and lower lows. You understand me? So now let's go to the sideways trend. For the sideways trend, the market moves from a low price onto a high price, okay? Then it comes back down to that same low price, which is equal. So it's an equal low. It's not higher, it's not lower, okay? Then it goes back to a high that is equal to this other high, so it's an equal high. And it drops back again to an equal low, then it's an equal high, then an equal low. So the market, where it moves like this, in the case of the sideways trend, it means that the market is neither buying nor selling. It means it's gathering momentum, it's gathering volume, it's gathering liquidity. So it's trying to trap people in a range. Do you understand me? Another word to use for it is a consolidation. Okay, so these are the three basic market structure types that you should know about, and I'm going to explain how to use them to trade onto you. Okay, so the next thing we'll be looking at here is market structure shift. Now we've already known what is a bullish, that's an uptrend, right? A bullish trend. An uptrend is also a bullish trend. So, and then how do we look at market structure? Do you understand me? Let me go back a little. Okay, so the market, this is a bullish market structure shift I want to show to you. The market has been coming down, as in this case, like a downtrend, like you know. Then this is a structure of a downtrend. This lower highs, lower low, lower highs, lower low. Okay, so the market all of a sudden at this last lower high, look at this last lower high here, this last lower high. So the market moves such that it breaks it above. Once the market breaks this last lower high, that is what you call bullish market structure shift, okay? Or bullish shift market structure is the same thing, okay? So the market shifts that way. So it has broken the last lower high. So what you'll be expecting is a return back to that low. But let me explain. A bullish market structure shift occurs when the market changes direction from downward to upward, indicated by the price breaking the last lower high and closing above it, as in this case. So what I'm expecting is for it to return back into this last lower high. So once the market returns here, I'll be placing a buy here, and this is where you expect to enter a trade, and then you expect it to go upwards. The reason is the market is changing, is shifting structure from a downtrend to an uptrend. So this is how you buy a trade. What I just shown to you now is a strategy that will not stop working. It works in any asset, it works in any market, no matter the market you're looking at. A market structure shift is a very key zone for you to look for entering a position. Do you understand me? So how do you place your stop loss and your take profit? I'm going to show that to you on a live chat, okay, but not now. So let me not look at a bearish shift in market structure. The market would have been trading upwards, as in this case, and then you consider the last higher low, okay? This is the last higher low, like you also see in the other one. So then what we're expecting is the market to come back down to break it below. All right, so once this happens, there is a bearish shift in market structure, and the bearish shift in market structure occurs when the market changes direction from upward to downward, indicated by the price breaking the last higher low and closing below it. So once it closes like this, then you begin to see that the structure is no longer an uptrend. All right, so you wait for a return back to that level, okay, which is the last higher low, and then you expect to sell downward from that place. Okay, so that is how market structure shift is interpreted. So the market structure shift takes place when there is a break, a change in the direction from what it was before to another one. And you know that by a break of the last higher high, a break of the last higher low, or a break of the last lower high. So that is how you are able to identify a bearish or a bullish shift in market structure. I hope you get what I just said. The next thing I'll be showing to you is how you can identify this type of thing on a live chart. And I'll be explaining how to place your stop loss, how to place your take profit using the bullish or the bearish market structure shift to enter a trading position. It's very important that you understand the market structure shift. If you don't understand it, you can rewatch this part again. Okay, you can rewatch this part until it enters into your mind. Then you can now begin to look at the live charts. Okay, we can look at the price chart now. All right, so let me show this to you on a live chart. I'm just going to show you this example, and in the second part of this tutorial, which is part 2, I'm going to give you more examples and more variation of how the market structure shift works. Okay, so now this market has been trending sideways. Okay, trending sideways. Then it got to a high at this level here. Here we see. And from there it started dropping down, started creating this kind of a structure of a downtrend. All right. So what we see is that the market started moving from here. Okay. Then started moving like this. I believe you can see the line I'm drawing. So this is a structure of a downtrend. All right, it's been creating lower lows. Then a point came, the market started creating almost like equal low here, then a higher low a little. Then what happens? Shift in market structure. This is the shift in the market structure I was talking about. Okay, so at this level here, we see a shift in the market structure. So this becomes the area of interest. You understand? So ideally, the whole of this red line, the red candles are the other block. Okay, but sometimes in order for me to minimize my risk, I just highlight the mitigation block that is here. We explain details of difference to you. I think I've also done videos on that before. All right, but let me just say, for now, this is the area where I'll be looking to enter the buy. Let me remove it. Okay, so the markets have reached here. So what we're expecting is for it to continue to this level. All right, maybe it gets here, then we know it's time to buy. So we buy from here and we buy upwards. Are you seeing that? So that is how you trade a shift in market structure. Market has been coming down. All right, as we're coming down, then all of a sudden it broke the last lower high. This is the last lower high. Are you getting me? This is the last lower high. Nearly broke it. The expectation is that it will turn back to it downwards, and if that's where you now pick your buy. You understand? So that is what I have been talking about. All right, let me remove all these lines and then show you another thing. Okay, now the market have reached here, and after it got there, started creating structures of an uptrend in this manner. Okay, started creating structures of an uptrend. These are higher highs and higher lows. All right, so it started creating this structure, higher highs and higher lows. Then, as you would see, created a high that's kind of lower than the previous one. Then here comes the shift. Are you seeing this? The market has broken this level. So here comes the shift. This is the last lower low. Okay, our expectation is market to return into that block in this manner. Are you seeing it? So I expected that after the market breaks that place, it will return back into the shift in market structure. Once it returns back to that shift in market structure, that's where you now sell from. Okay, that's where you sell your market from, and you see how it went down. So sometimes you may not be this lucky to go that far, but sometimes you can be very, very lucky. Now you can use the shift in market structure to continue a trend. You can use it to spot a reversal in trend. It just depends on how the kind of trading style you want to adopt. All right, so I use it to follow a trend, and I also use it to reverse the trend. Do you get me? So I trade both types of trading. All right, so that is what I needed to show you in this video. I'm going to show more of this scenario to you in our next class. So this is the Cash 500 index. There are many other assets I can show it to you on, but maybe our next class I'll show to you how it works in Forex. It's the same thing. So then I'll also show you the variation. But like I already said, how do you put your stop loss? Just imagine as I've placed the entry here. Okay, so here is my entry. Okay, here is my entry, while the stop loss was here. Now I could be wrong, so sometimes in order for me not to be wrong, I used to adjust the whole of the box like this. So I take the whole of this as my entry and stop loss. So once that is done, I am guaranteed that I will take something out of that trade. So that is how you spot the shift in market structure and you use it to trade profitably. So I believe that you get this analysis. So if you don't get it, just watch the video again, you will get it. But also I will do more other videos like this for you to understand how the shift in market structure is used to enter a trade. All right, till we see again in the next class, thank you for watching and keep on making money as much as possible. All right.